Hello, I'm Savvier, and today let's dive into the collapse of Signature Bank. Signature Bank was a New York-based full-service commercial bank founded in 2001, regulated as a state non-member bank, and by 2022, Signature had grown significantly, managing over $110 billion in total assets, ranking 29th amongst US banks. Signature's core businesses fueled rapid growth. CNI and CRE lending soared, crypto deposits hit 28.7 billion via Signet, and fund banking reached 41% of loans. In 2022, the Fed aggressively raised interest rates from near zero to 4.5%, while the collapse of major crypto firms shook the digital asset sector. Together, these shocks slowed the US GDP growth and placed significant strain on the banking sector. Signature's decentralized structure of private client groups increased autonomy and drove growth, but weakened oversight, while its incentive model prioritized deposit volume over risk. Now, moving on to its key risk drivers. As Signature more than doubled in size from 2019 to 2022, it failed to scale its risk controls. When crypto deposit caps were breached, the board raised its limits instead of mitigating them. Meanwhile, weak governance and informal decision-making left leadership blind to growing exposures. As such, this weak risk foundation led to Signature's fragile business model. Due to their aggressive growth strategy, Signature's exposure to uninsured deposits grew sharply, rising from 63% of assets in 2018 to 89% by 2022, one of the highest amongst US banks, in contrast to its peers which just held 31 to 41%. Now, let's take a closer look at why this risk built up. So Signature's private client group targeted commercial clients with large uninsured deposits over the FDIC insurance cap, prioritizing volume over stability. This was amplified by an aggressive crypto push and COVID-era liquidity, inflating deposit levels but increasing volatility. So these deposits can be withdrawn instantly at the first sign of trouble, as it is uninsured, making it highly sensitive and could cause a bank run. When large concentrated withdrawals occur, the bank faces immediate liquidity strain and operational instability. Without enough cash on hand, it may be forced to sell assets at a loss, seek costly emergency funding, or suspend lending altogether. And in 2023, panic after peer bank failures triggered a run on Signature, draining 18.6 billion or 20% of its deposits in hours. Adding to Signature's risk was a 490% surge in fund banking loans over 2 years, reaching 26 billion and making up 41% of its portfolio. Fund banking was not only large but risky. The 26 billion in illiquid long-term capital call loans couldn't be sold quickly or used as collateral due to its maturity mismatch and sector linkage, leaving Signature without backup liquidity in crisis. Moreover, Signature's 34 billion CRE portfolio posed major risks. 70% was tied to New York with high loan-to-value ratios and with over 593% of Tier 1 capital, far above safe limits. Rising interest rates made it harder for borrowers to refinance commercial real estate loans, reduce property values, and increase the risk of loan defaults. Moreover, macroeconomic shocks further strained Signature's already fragile business model. In 2022, the Fed raised rates by 450 basis points, the sharpest hike since 1980s. This eroded the value of bonds and securities, limiting Signature's collateral for emergency funding and worsening liquidity stress. At the same time, the bank paid more to retain deposits while earning less on fixed-rate loans, compressing profit margins. By quarter 4, Signature faced 3.2 billion market losses and 1.4 billion in unrecognized loan losses, weakening its balance sheet and limiting its ability to raise liquidity without incurring further loss. Signature's crypto push fueled rapid growth, adding 30 billion in deposits from 2020 to 2021, over 80% of total growth. By 2022, crypto made up of nearly one-third of all deposits, leaving the bank highly vulnerable to market swings. FTX 2022 collapse triggered fear and scrutiny of Signature's crypto ties. Despite not holding any crypto, lawsuits and short seller claims damaged trust and sped up withdrawals. Signature's deep exposure to crypto made it highly vulnerable to market volatility, as crypto shocks like Terra USD and peer banks failed, causing panic to spread. With 20% to 30% of deposits tied to crypto via Signet, the bank saw 18.6 billion in rapid outflows, averaging 11 million per transaction. Now, moving on to its responses. In response to crypto turmoil, Signature aimed to cut crypto-related deposits from 23.5% to under 15%, targeting a 8 to 12 billion runoff. It also issued a press release clarifying FTX exposure was just 0.1% and denied being a crypto lender, distancing itself from broader industry fallout. However, these responses proved ineffective. The plan to gradually reduce crypto exposure only signaled weakness. Stakeholders saw the bank admitting it was overexposed to crypto instead. The plan needed months, but market panic was immediate. And while the bank tried to defend its reputation, reassurances rang hollow given that up to 30% of its deposits were crypto-linked. With lawsuits and media pressure mounting, confidence continued to erode. Now, to manage rapid outflows, Signature mobilized emergency liquidity, drawing on existing reserves, seeking advances from the FHLB, and attempting to access the Fed's discount window. At the same time, they worked with the Federal Reserve Bank of New York to resolve funding shortfalls. As withdrawal requests surged up to $7.9 billion on March 13, they activated contingency funding plans to raise liquidity and meet depositor demands. While Signature took action on the bank run, its responses were ultimately ineffective. Emergency liquidity was mobilized too late with no pre-arranged collateral and poor visibility on pending outflows. Internal coordination was slow and fragmented, delaying decisions when timing was critical. Even its contingency funding plans were poorly documented and couldn't be executed under pressure, revealing a severe lack of preparedness for a crisis on this scale. Now, despite repeated regulatory warnings over several years, Signature Bank failed to take meaningful action. MRBA's and supervisory recommendations kept highlighting the same liquidity and risk management weakness, yet the bank responded with surface-level check-in-the-box fixes. By the time of its collapse, only 1 out of 18 liquidity issues had actually been resolved. This lack of urgency and failure to address root problems left the bank vulnerable and regulators deeply concerned. Some examples of this were the dismissive and overconfident nature, consistent ineffective contingency planning reforms, and stress testing enhancements which lacked realistic data. As such, Signature grew too fast without proper controls, taking on more risk than they could handle. It wasn't prepared for a bank run, giving a false sense of security, and when the crisis actually hit, poor planning and slow response made the situation worse. Interestingly, Signature thrived during the 2008 crisis by staying conservative, but by 2023 it shifted to riskier strategies, crypto exposure, uninsured deposits, and poor liquidity planning. The lack of discipline played a key role in its collapse, and as such, proper risk management is essential to ensure institutional resilience, maintain stakeholder confidence, and mitigate systemic vulnerabilities.